Good afternoon, everyone. It's Tuesday, March 10th, 2020. What a week it's been so far. We had a dramatic drop in the stock market on Monday, only to see more than half of those declines erased in today's rally of over 1,000 Dow points. It's clearly a period where we're having tremendous volatility of individual companies and sectors, and there's a lot of moving parts, and I'm here to try to help explain what's going on and what we're doing about it in this period of time. First, it's clear that the stock market is having a difficult time pricing in what coronavirus really means for the U.S. economy. We know that it's bad. Many companies have pre-announced and said that their businesses are weak and that they're not going to maintain guidance, but beyond that, they don't have any other visibility. That's very difficult, a very difficult period for analysts to really ascribe a valuation on certain businesses. Secondly, and we have new information, a new price war between Saudi Arabia and Russia. That caused a tremendous drop in the price of crude oil. Really started last Thursday with a failure of OPEC to come to an agreement, and then over the weekend, the Saudi kingdom coming out saying that they were going to dramatically lower and give discounts on the price of oil. This was meant to hurt the Russian economy and to get them to be more price disciplined as well. But the collateral damage through all this are U.S. producers of energy products, the shale producers, certainly, who have enjoyed tremendous growth over the last several years. So to net it all out, it's really the accumulation of a lot of uncertainties going on more recently, and those uncertainties are difficult for the stock market to price in right now. So what do we do, and what do you do in a period like that? Well, first of all, you want to step back and look at the companies that you own. We are focused on owning companies that have strong management teams with great balance sheets and companies that generate a lot of cash. It's not a time to speculate in loss-making companies, and at all costs you want to avoid permanent capital destruction, because if a business requires capital and needs to access the debt or equity markets and those markets aren't open, they could be really out of luck and not see and not be able to fund the ongoing operations. So how is this all going to play out? Well, I'll contrast this period of time that we're in right now to last year. In the fourth quarter of 2018, we saw a very sharp drop in stocks as there were growing fears that the Federal Reserve was in the process of creating a recession, or at a minimum a slowdown in the U.S. economy. They took the unprecedented step of reversing course and dramatically lowering interest rates over the course of 2019, which led to the new highs that we saw in the fourth quarter. This is very different. This is not going to be a V-shaped recovery. This is going to be more of a U-shaped recovery. We're going to see a lot of volatility up and down. We're going to have good days, we're going to have bad days, and we're just going to focus on picking our spots with the best companies that we can find, purchase them, maybe even trading around positions a little bit more than we normally do, because I think we're going to be range bound for a period of time until it becomes clear that the coronavirus has run its course. There is a silver lining to all these things. With the Federal Reserve's recent actions of lowering interest rates, that's stimulative. A price war to lower energy prices between the two economies caused a sharp decline in energy prices. That's also stimulative, because consumers, a linchpin of the U.S. economy, are going to see lower energy prices at the pump. This is money in everyone's pocket, and will hopefully sustain many companies, many people through a more difficult economic time. I think the next 2 quarters are going to be very lackluster for corporate America. I think the earnings are going to be are not going to be inspiring, and I think that corporate CEOs are likely going to give very conservative guidance, because why shouldn't they? They really don't know ultimately what the economy is going to do. But I think we're well into this. I think there's a pathway to come out on the other side, and I think a year from now, stocks will be higher than they are today and potentially materially higher with the stimulative effects of these more recent moves and other things in the economy that were already in place. If you have any comments or questions, feel free to reach out to me or anyone else at Palisade Capital. Thank you very much for listening.
The information contained in this webcast reflects the views of Palisade Capital Management, LLC, as of the date of its original broadcast, and such views are subject to change without notice at any time. All information provided in this webcast is for informational purposes only and should not be considered investment advice or recommendation to purchase or sell any specific security. While the information presented herein, including information obtained from third parties, is believed to be reliable, no warranty is made concerning the accuracy of such information. There can be no guarantee that any forecast discussed in this webcast will be realized. Consult your financial advisor before making any financial planning or investment decisions. Past performance is not a guarantee of future results.